Welcome, everyone. We're going to begin the webinar on understanding the insurance game and winning, hosted by Impact. I'm Melissa Jolls with RDA Impact, and we have John Halstead, Director of Business Support for RDA, is your presenter today. The webinar will take approximately 30 minutes. We are recording it, and we'll post it on our website under training videos. If you do have questions, you can type them in the chat box at the bottom right of your screen, and John will answer them at the end of the presentation. Now, I'm going to turn it over to John.
Okay, good afternoon, everybody, and anybody on the West Coast, good morning. Glad to have you join us. I'm very happy to present this webinar. Is dealing with insurance companies stressful for shops? Those of you that are out in the trenches every day, I'm sure have an answer for that. Certainly, the insurance industry is much more dominant in the collision business than ever before. It can be stressful dealing with insurers. It can be confrontational at times. Sometimes maybe we feel it's not a fair process. They may feel that insurers are demanding or won't pay for things we think they should pay for. But what I want to talk about today is to better understand the insurance business, the factors that affect them, and some tips on how we can negotiate better with the insurers. Stephen Covey once said, seek first to understand and then to be understood. So that's what we're going to try to do, is understand things from the insurer's perspective a little bit better. So the three topics we talked about in prior Impact Collision Solutions issues are understanding what drives insurers, managing three KPIs critical to insurers, and finally negotiating with insurers. What we want to do is create a win-win-win situation if we possibly can, because we want our collision center and distribution personnel to better understand what makes insurers tick, how to position a collision center to create mutually beneficial outcomes for customers, insurers, and collision centers. You know, really what we're looking for in a collision repair, I believe, is a correct repair performed on time, cost effectively, and profitable for the shop. I think if we achieve that, we've got basically what the shop's looking for, what the customer's looking for, and ultimately what the insurers are looking for. Now, understanding what drives insurers, consumers give their premium dollars to an insurer in order to lessen risk. Will that be a risk of an accident, or a risk of a fire, or a risk of a death, or whatever it happens to be, but they're basically trying to transfer risk from themselves to the insurance company. Insurers accept that risk in exchange for the certainty of an insurance premium. Insurers purchase services from collision centers and others to fulfill their claims obligations. And finally, insurers invest premium reserves for additional income. Now, there are many factors involved economically for insurers. The first one is demographics. Are there more or fewer drivers? What are the ages of those drivers? What are the things that affect the population of people looking for insurance paying insurance premiums? There's the actuarial probability of the severity and the frequency of a claim. This relates to the loss ratio, which we'll talk about in a little bit. There's the cost of processing a claim, which insurers call loss adjusting expense. And then there's actuarial, administrative, and sales expenses, or overhead, involved in managing an insurance company. There's also state-by-state regulation of premiums. There's repair costs and changes in that, technology, rising vehicle costs, salvage values, etc., that all factor into the well-being of an insurance company and their economic factors, costs, and so on and so forth. And finally, competition with other insurers. There's fierce competition with all insurers, as we all see on the TV every day when they're all competing with one another. And lastly, investment returns and interest rates. One of the theories of insurance was if they broke even on underwriting, they could make money on investments. Well, unfortunately, with the interest rates being low for the last 10 years or so, that income on investments is lower than it has been historically, so it forces them to be a little more diligent about making money on underwriting. Now here's some insurance fundamentals. The sales, this is kind of a profit and loss statement, if you will, for an insurance company. Their sales is premium income, those dollars they're collecting from the insureds in premiums. Their cost of goods essentially are the losses. Now typically, and it varies year to year, but typically their losses range from 55 to about 70% of premium income. Then they subtract their loss adjusting expense, the cost of adjusters and whatnot, which is about 13%. And finally, overhead, which is typically around 23%. Then they got their net operating income or loss. That's pretty much their bottom line before any investment income. So when you look at that picture there, they're break even in terms of losses. LAE and overhead are relatively fixed expenses, so the variable from year to year is their loss ratio. So if an insurance company had a 64% loss ratio with LAE at 13 and overhead at 23, that would be a break-even picture for them. So if their loss ratio was above 64%, they'd be losing money, and if it was below 64%, they'd be making money. The note down here at the bottom I pulled off the internet the other day basically said that State Farm joined the ranks of property and casualty insurers reporting challenges in the auto insurance line of business. State Farm said it lost $7 billion in its auto insurance underwriting in 2016. And it also said that overall State Farm and all of its lines also lost $5.5 billion in 2016 on an earned premium of $61.7 billion compared to an underwriting loss of $2.1 billion in 2015. So as an example, State Farm 2 years in a row lost on their claims. They lost money on the underwriting piece of the business, which obviously is not sustainable. Now, I just saw something in Collision Week came through today that basically saying that premiums are increasing, and I'll explain why that comes about in a minute, but premiums are increasing because of these losses. When insurance companies suffer losses, they've got to raise premiums. And so the premiums have been increasing, and they eventually will get back on a profitable footing. This insurance cycle up the upper right-hand corner is an illustration because the insurance company is very cyclical. As we talked about in this situation with State Farm, higher loss ratios up at the top right here are going to drive them to focus on cost containment and to go to the regulators and look for increased premiums. Now, when they get those increased premiums and they've cut their costs or focused on costs, then the profits come up, they get more profitable, but they're also facing increased competition, and they put a more focus on policyholder satisfaction. And when they do that and loosen up the purse strings a little bit in terms of paying out losses, then they have higher loss ratios, and they go back to focusing on cost containment. So it's a cyclical process of constantly going back and forth and balancing. How do I take care of my customers? I want to do it. I want to retain their business, but I have to do it cost effectively. And when their loss ratios get out of hand, then they've got to seek premium increases, and the whole cycle begins again. So it's a cyclical process of insurance companies constantly battling between customer satisfaction, competition, and managing their costs. So the big variables for an insurance company are loss ratio and LAE, and collision centers can influence both of those. I'll show you now. how that comes about. The second aspect that we'll talk about is managing the 3 KPIs important to insurers. They are CSI, which is policyholder satisfaction, severity, which includes rental costs for an insurer, and cycle time. There are secondary metrics such as that are important as well, such as alternate part use, repair versus replacement labor, supplement ratios, estimating accuracy, and so on and so forth. Now let's talk about CSI for a minute. Insurers spend billions to attract new policyholders, but it's much easier to keep one. A happy policyholder will renew their policy, but a claim is the moment of truth. So every time an insured has a claim, then that's the moment of truth for the insurance company, and it's going to determine whether or not that policyholder stays with the company or not. I know you've all seen the TV ads of Farmers and Liberty Mutual and Nationwide and Allstate and so on and so forth. They talk about accident forgiveness and things of that nature. They're all competing for those premium dollars because the population of drivers is not increasing tremendously, and they're all fighting for that. The second aspect is important to insurers is customers rarely differentiate between the insurer and the repairer when they have a claim. What the consumer is concerned about was the vehicle delivered on time? Were you kept informed throughout the process? And would you recommend this collision center to others? So from a consumer standpoint, there's a fog between the insurance company and the collision center in terms of customer satisfaction. They consider the insurer and the collision center pretty much all on the same boat from that standpoint. If they're unhappy with one, they're going to be unhappy with the other. So CSI is very important, and it's something that obviously it's important to a collision center as well, but it's also important to insurers. And the better a collision center does with its CSI, the better relationship they're going to have with those insurance companies. There's what determines customer satisfaction? And there was a survey done a number of years ago by Allstate and AutoChecks that talked to collision center customers, and they differentiated between what they called complete customer satisfaction and a customer simply being satisfied. Now, a consumer that said they were completely satisfied was much more likely to return to the collision center for future business and or refer it to others than somebody was just simply satisfied with the job. They wanted basically a raving fan, if you will, of somebody that really was really satisfied with the situation, and that made a difference in terms of referrals. There's 4 aspects of that is kind of interesting. What was most important to the consumer was the number one thing: were they kept informed? We talked about that on the previous slide. Second thing was was a vehicle delivered on time. Third was, were they treated well? And number 4 was everything completed delivery. Now, the interesting thing here is, even if the vehicle was not delivered on time, if they were kept informed throughout the process, they were still completely satisfied. So actually keeping the customer informed is actually more important than actually delivering the vehicle on time. Obviously, we'd want to do both, but keeping the customer informed throughout the process was absolutely number 1. The other thing that's kind of interesting, and treating people well is kind of intuitive. Everybody wants to be treated well, but the other thing that was really stood out here is everything complete at delivery. Now, normally we think, yeah, okay, that's going to be the case in pretty much all the time, but there are many instances that there may be some minor aspect that isn't complete at delivery. If a missing molding or an emblem or something minor that you ask the customer, well, here's your vehicle, but can you come bring it back tomorrow or the next day, and we'll take care of this for you. That was a game breaker for a lot of the customers. So that was very significant, as everything being complete at delivery is a very, very important aspect. So probably even more important than delivering it on time. So if you have to, delay it a day and have it complete, that may be better off than to deliver the car and have them have to come back. So, the next KPI that's important to insurers that collision centers can manage is severity. That's the total cost of the repair. And things that affect that obviously are labor and material rates, not included operations, rental costs, which are also affected by cycle time, repair and replacement decisions, alternative parts use, and the mix of small and large repairs. A shop can manage its severity, overall severity, by mix of work. So if you're really, really good at small jobs and can get them in and out very quickly, certainly that can both help your severity numbers as well as lower your cycle time. Severity and frequency determines loss ratio, so insurers focus on cost containment when the loss ratio is too high. That's a cyclical process. So if you see insurance companies really grinding on cost containment and whatever, then you know their loss ratios have been high and they're working to curtail that. But this is something that, again, collision centers can manage and monitor and see where they stand, so they can be as proactive as possible in helping manage the severity for their insurers. Cycle time is extremely important because for insurers, it affects rental costs. The longer the car is in the shop, the higher the rental cost, which is huge for insurers. With literally thousands of claims, an extra day or two of rental car cost is very, very expensive. Cycle time also affects the time adjusters are engaged in the claim process and reserves are tied up. The insurance company wants to close that claim out as quickly as they can to free up their adjusters. That reduces their loss adjusting expense, and by closing out the claim, they can free up any reserves they've had tied up because of that loss. So and obviously it has an impact on the policyholder as well as the collision center customer, and it also affects the capacity of the collision center itself. If you can increase your cycle time or decrease your cycle time, increase your throughput of the facility, you'll actually have more capacity to do more work. A good surrogate for cycle time is rental car days. Here's Enterprise publishes data regularly in terms of cycle time based on rental car days, and you can see in 2018, first quarter of 2018, the average cycle time went up to 12.5 days, an increase of 4/10 of a day, almost a half a day since the first quarter of 2017. So when you look at that on a global basis, insurance company basis, that's a huge number. A half a day of cycle time is huge when it comes to rental car costs for these insurance companies. So that's something that, again, collision centers can manage and monitor and have some influence in managing and keeping it as low as possible. So to recap on the KPIs, collision centers can proactively monitor their performance in these three important KPIs, CSI, severity, and cycle time. The better off you are to manage those proactively, the better you are when you have a negotiation with an insurance company or a DRP. They'll have their own numbers, but you want to have your numbers to make sure as a check and balance against their numbers, because they may not agree. If they're on you for one of these numbers, your severity, you're saying your severity is too high. If you've got some data that says otherwise, you've got something to talk about and negotiate. If your cycle time is superb, and maybe you could get away with a little higher severity. Certainly CSI is important as well. So knowing what your CSI is, knowing what they think that your CSI is very important when dealing and negotiating with insurers. Now, talking about negotiation, and one fundamental fact of life is a collision center sale is the insurer's cost. Just like any other business transaction, and that's where the tug of war comes with insurance companies, because they want to control their costs. We want to increase our sales. However, when you buy something, what do you want to pay for it? I think that's a rhetorical question. I think most people will say as little as possible. When you sell something, what do you want to receive for it? Again, most of you are probably going to say as much as possible. That's where the negotiation process comes in. Certainly, insurers want to get their work done for the lowest possible cost. Collision centers want to sell their work for the most they can possibly get. And that's where where the negotiation process comes together. You know, there's a thing in the legal community that says if the facts are against you, argue the law. If the law is against you, argue the facts. If the law and the facts are against you, pound the table and yell like hell. We don't want to be the ones pounding the table and yelling like hell, but in this situation, what are the facts and what is the law? Well, the facts in an insurance claim is the actual damage and the pre-accident condition of the vehicle. Those are very clear facts. We know exactly what the damage is, assuming we've disassembled the vehicle and we know have identified the damage. And obviously the pre-accident condition of the vehicle is important as well. What kind of make and model, was it a new car or an old car? You know, what kind of condition is it in, so on and so forth, because that kind of affects, what we're going to do to it eventually. The law is procedure pages. You know, the database procedure pages, Mitchell and CCC and so on and so forth, Mitchell and Motor, CCC. The law is OE repair procedures, which obviously is getting a lot more play today with the advanced electronics and crash mitigation thing. OE procedures is the law, ICAR standards, and other authoritative documentation is the law. So the point is you want to be able to communicate with the insurance company, citing the facts, what the actual damage was, and the law. What's the law in terms of the correct procedures to repair this vehicle from all these sources, and to be authoritative about it and be able to document it. Now, when it comes to negotiations, there's 4 principles I'll talk about here, as well as the facts and the law. But the number one thing is to understand the concerns of your mutual customer. That's the car owner, policy holder, and so on and so forth. Want to understand what's important to them, because that's ultimately who you have to satisfy for both the insurance company and the collision center is to understand what's important to them. Whether it's getting the car back and quickly. Obviously, it's quality, whether it's color match or whatever the issue is, structural issues, whatever is important to that customer is what you need to focus on to satisfy them. Secondly, we need to understand the needs of the insurer and the adjuster. As we've talked about, the insurers have economic factors that are important to them in terms of customer service and loss ratios and all those kinds of things. We know what's important to them. But also the individual adjuster has needs and interests as well, and it could be based on what kind of personality they have, whether they're just a social kind of person, or they're just about getting the business done and getting out of there or whatever. But whatever their needs are and what the personalities are can affect how you negotiate with that adjuster to meet their needs. Are the things that you can do to make their life a little simpler, and what's of value to them in that and the relationship you have with them. You know, can you do some adjusters may want you to write the damage before they get there, some won't. You just have to understand what the needs of the adjuster are. Thirdly is we need to document all damage. a complete description of all the actual damage, the facts, with photos that accurately illustrate the nature of the damage and the choice of repair procedures, including parts repair or replacement decisions, is essential. And we want to provide a documentation from authoritative sources, the law, that supports your repair approach. And finally, we want to seek win-win-win solutions. As I said before, a correct repair performed on time, cost effectively, and profitable for you. So those are some kind of principles. Again, this is all a case-by-case basis. So it's all based on the personalities involved, the people involved, the insurance company involved, and the actual repair being done. But basically, if you take care of the concerns of the consumer, if you identify the needs of the adjuster and the insurer, you document all the damage, and then it's a matter of negotiating the most cost-effective repair that can be done and get it done quickly and on time. So being proactive when it comes to this process will certainly help you. As I said before, document the facts, reference the law. Don't be the one pounding on the table, and focus on mutual interests. Negotiation can be an opportunity to advocate for the outcome that is best for the customer, the insurer, and the collision repair facility. Again, if you keep the focus on the customer, what's doing the right thing, again, you will always do the repair correctly. It's just a matter of what you'll be paid for it. Now, here's one thing that comes up frequently, and people are always saying that what insurance companies will or not pay for, and so forth. This gets into not included items in terms of on specific estimates. And here's a slide that came from Mike Anderson's Collision Device rankings for overall payment frequencies for certain not included items. And the way this works, and this is an average of several insurance companies nationwide. And the ranking of 3 means the insurance company always pays for it. A ranking of 2 says they pay for it most of the time. A ranking of 1 says they pay for it some of the time. And a ranking of 0 means they never pay for it. And so the most common of these not included items that are most often paid for is two-tone paint, which I think is pretty straightforward. If it's a two-tone job, write it that way, they're going to pay for that pretty much all the time. Stripe tape, same kind of deal. That's a pretty straightforward. Obviously, a lot of people here in the field, a lot of times, so people say, well, the insurance company won't pay me to blend. Well, it just turns out blending adjacent panels for color match is number 3 on this list. And quite frankly, based on the data, they either, it's halfway in between most of the time and always. So pretty much frequently, almost nearly all the time, if you're right for blending, they're going to pay for it overall. Again, maybe a particular insurance company or a particular adjuster or particular situation may have a problem, but this is the kind of information that you can utilize to support your case for some of these not included operations, such as blending and other factors. So just bring that up in the fact that in terms of documentation and understanding and negotiating, that's certainly having this information, knowing what other people are doing, knowing what the insurance industry is actually paying for is important. So often when negotiating, whether you think you can or you think you can't, you're right. And so the case is you don't win every negotiation. It's always somewhat of a compromise. But if you have a good positive attitude and you document yourself and you feel you've got a good case, if you think you can, you probably can. And if you think you can't, you probably won't be able to do that. So Anyway, just to recap on these negotiating principles, understand the concerns of your new mutual customer, identify the needs of the insurer and the adjuster, document all damage, and then seek win-win-win solutions. Thank you very much. That's what I have for today. And Melissa, if you got any questions, I'd be happy to answer them.
We don't right now, but if anybody does have questions, you can go ahead and type those in. You were right at 2:30, right on 30 minutes. That was a great job. And I will follow up by sending everybody on the call John's contact information. So if you do have questions, you can follow up individually. And we'll get you the link to this webinar. So if you want to show it to other people in your organization, you can do that as well. I don't see any questions. So with that, we'll wrap it up. That'll conclude this webinar. We appreciate everybody who participated today, and we'll be in touch with future training opportunities. Thanks, and thank you, John.
Thank you.
Take care.